Using a different gauge than the Case-Shiller, annual home price growth pulled back in January, falling to just over 3% from around 3.4% the prior month. That's according to the Intercontinental Exchange's home price index. Here to dig into the data and what it means for the housing market heading into the busy spring season, we've got Andy Walden, who is the head of mortgage and housing market research at Intercontinental Exchange. Great to have you here with us, Andy. So just take us into the reading as per the ICE metrics.
Yeah, and I mean, we saw the same thing late last year, right? So when you look at late 2024 home price growth, it picked up a little bit over the last 3 months of the year, according to our index as well. We're starting to see an inflection, though, as we move into January, and that annual home price growth rate is starting to come down. If you look at the better part of the last 9 months, we've actually been operating closer to a excuse me, a plus 2% annualized growth. So it suggests that, you're just talking about those high levels of home price growth. That annual growth rate could start to ease here over the next couple of months as, it more accurately reflects what's actually been happening here more recently in the market.
But we're still essentially within the same ballpark mortgage rate as we were this time last year. So there hasn't really been a ton of movement. How is that anticipated to be a differentiating factor this year versus last year?
Yeah, and it's slightly better as we stand here today than it was at this point last year. The other thing to keep in mind is as we move our way through 2025, if you look at the futures market and where the street is kind of placing its bets in terms of where mortgage rates are going to go, you're likely to see about 0.25% relief in mortgage rates. At least that's the anticipation right now as we make our way through the year. And so a little bit of a modest reprieve in home affordability as we make our way through. The other thing that's very different today than it was a year ago is that there's more homes out there available for purchase. So if you look at the market in January, there were 25% more homes available to buy in the market than there were at this time last year. We're seeing the strongest inventory levels, even though we're still running a deficit, the strongest inventory levels that we've seen really in the better part of the last 5 years out there in the market. Now, you guys were just talking about New York City and home price growth that still remains strong in that area. There's a lot of variation across the country in terms of inventory deficits and where we stand right now. The Northeast is really still starved for inventory. And so that's why you're seeing some of those stronger home price growth rates up there. When you look across the Sun Belt, a good chunk of those markets are back now to pre-pandemic levels of inventory, and that's where you're starting to see prices soften.
Okay, and so there we go. We're taking a look at some of where prices have softened, and a green arrow in this context means good, even though it's pointing down, because ultimately that's some relief for potential buyers out there. All those areas that you're tracking right now, how much of this can you tie back to some of what we were discussing in return to office mandates, or just migration that now once again has to unwind because we can't be as hybrid as we were before, I guess?
Yeah, it's a combination of all of those things. And when you look at the Sun Belt, you start to look at new construction activity down there as well. There's a stat that, 3/4 of new home construction coming to market last year actually came in the Sun Belt. And so that helps for some of those existing homeowners that are still locked into their homes by low rates. You're seeing some of that new construction inventory help with the supply constraints down there. You're also seeing a number of other factors, rising property insurance in those particular areas, the migration inflow that's slowed down into those particular areas, back to office in New York, right? So there's a number of different factors that are contributing to this, but really it's that inventory component. It's not so much affordability that's driving price right now or the lack thereof. It's inventory. And when inventory returns, you're seeing those prices soften up. In areas where you're not seeing that inventory return, the Northeast most notably, you're seeing still firm home prices.
With that in mind, as you're thinking through some of the policy implications that could have an impact on housing, whether that's the workforce and immigration policy impacting the number of available workers to build out homes, and then additionally on the materials itself, if we do see tariffs go into effect, how could that also have larger impact on the cost of new home build-outs?
Yeah, you're absolutely right. That new home construction is where that would come, both in terms of the lack of labor from that lack of immigration out there in the market, along with tariffs. If they're put specifically on lumber or construction materials, that can have an upward pressure on homes that would be coming to market over the next couple of years out there in the market. So something certainly housing market folks have a close eye on. What do we truly see in terms of these tariffs? You were having that conversation earlier in the show. What do we see in terms of immigration and the costs of this construction, and how does that play into the market as well?
As we're taking a look at some of the home builders here, home builders rallying on the day, at least during this activity. Andy, we're going to continue to track this very closely here. We appreciate you taking the time.
You bet. Thank you for having me.